This discussion is going to talk about the relationship and sometimes the disconnect between the economy and your investments. I'm Patrick Briscoe, financial planner at Bayswater Wealth Management, IPC Investment Corporation, and this is the Canadian Retirement Roadmap podcast. Let's talk about 4 timeless investing reminders for difficult economic times. This discussion comes from a newsletter that I recently sent out to clients when some of the news started to break about tariffs. Now, this does not necessarily apply to just tariffs. This could be any type of economic situation that starts to get us a little bit nervous about our investments. That could be like the rising interest rate environment we had a couple of years ago, the effects that COVID had on the economy, trade relations, any number of situations that could impact the economy. With 2025 heralding political and economic upheavals, the old adage rings true. The more things change, the more they stay the same. In times of uncertainty, focusing on some time-tested financial strategies becomes crucial. Major shifts can definitely be unsettling, yet they shouldn't unhinge our financial plans. The core principles of investing, such as diversification, long-term focus, and discipline, remain steadfast anchors and are things that we should definitely be remembering when things get a little bit turbulent. They're also what separates the good from the not so good investors. In fact, the average investor actually underperforms their own portfolio's investment returns simply because they make bad decisions along the way, such as trying to time the market by cashing in and out of their investment portfolio. By sticking to the basics, we're going to be able to safeguard our financial future against these transient whims of economic fluctuations, which are going to happen from year to year. And we will have little control over whether they happen or not. And the timing of these situations are so difficult to plan for that we're often caught off guard by them. So when difficult economic times do happen, I like to remind myself about these 4 key principles. First, markets are always forward-looking machines. Today's news is old news. The stock and bond markets will price in today what they think is going to happen 12 to 24 months from now. This is why markets jumped well before Donald Trump was sworn into office, and why they started rallying in April of 2020 while we were still in the depths of COVID. At a time when we were still facing lockdowns, there was no vaccine in the future, and we had a very uncertain outlook on what was to come. Yet markets rallied. And this is the often disconnect between what we expect to be happening and what actually happens, because markets are always looking ahead, whereas we're kind of examining the news as it's happening. If we're reacting to the news, it's often too late. It's really hard to outsmart the market. And this ties in very well to point number 2, which is that the economy is not the market. So although economic conditions can affect investment markets, the two are not the same, and the timing is rarely in sync. Legendary investor Peter Lynch actually said, if you spend 13 minutes a year on economics, you've just wasted 10 minutes. The point being, you can examine the economy all you like. It isn't necessarily going to give you the information you need to know what to do with your investments at this time, because the two are disconnected. As an example, previous recessions have shown that by the time the economic indicators suggest that we're in a recession, stock indexes like the S&P 500 are already in recovery mode. So by the time we actually realize that we are in a recession, markets have already figured it out and they're already on their way up. So again, it's a bit of a trap where we can look around and see the difficult situation going on and think that it might be an opportunity to shelter our investments or get a little bit safer, when in fact we would be doing the opposite of what we should be doing in many cases. And this ties back into point number 1 above. Remember, although we may feel economic pain, that doesn't always mean investment pain. This is a really hard one since it's so counterintuitive, and it can be hard to feel good about our investments when the economy is hurting our pocketbooks. This is also why we often see outflows from investments at the very time when those investments start to go up. It's just because when we're looking at the world around us, it may be a negative period. Markets have already realized that and are looking ahead to the future, as we saw in point number 1, because markets are future-looking machines. Point number 3, the best minds are working for you. And I really like this one because it's a reminder of what investments actually are. Remember, you're an owner in the best and largest companies in the world with the deepest pockets and the smartest minds working for you. When you own a share in a company, which you would likely have as part of an investment portfolio, you are now a very small, but an owner of that company. And you get to share in the growth of that company. And that company and the people that work for it, their sole priority is to generate profit and increase value. And that's what they're going to do. Tariffs or no tariffs, rising interest rates, lowering interest rates. Companies like Microsoft, RBC, Amazon, and Costco, they're going to find a way to sort through this or whatever situation is facing them at the time and remain profitable. And I'm quite confident of that. This one often gives me a lot of comfort in tumultuous times because it is a reminder that we have the best individuals in the world trying to accomplish things on our behalf. Fourth and finally, markets generally aren't political. Politics is short-term, markets are pricing in for the long term. Warren Buffett once said that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. So let the not-so-good investors try and guess the votes. Let them make the day-to-day, week-to-week, or month-to-month decisions based on what they think is going to happen in the short term. What's going to end up happening in the long term, 3, 5, 10 years, is we're going to have market returns that reflect the average or a weighting of what actually is going on long term. So although we will have volatility in the short term, markets generally don't care about that. They're focused on the long term, and that includes politics. History has shown that regardless of the political party in power, markets continue to perform as they normally do. As an example, we've got some research here that I'll pull up on screen. And if you're just listening to the audio here, this shows the average annual S&P 500 performance dating back from 1933 to 2022. What it shows us is that under a Democratic president with various Congresses, the average annualized rate of return ranges from 9% to about 13.6%. On the flip side, when there is a Republican president, and we have a Congress that's either Democrat or Republican, the returns average 4.9% to 13.7%. So very similar rates of return, regardless of which political party is in power. Now, there tend to be more statistics coming out of the US. Canadian statistics would be very similar, but the idea remains the same. And that is whatever the politics or economic issue of the day happens to be, will likely be a distant memory in the future. And the impact that it has on the long-term growth of the market or your investment portfolio will likely be a nominal impact. Thank you for tuning in to this shorter episode on the 4 timeless investing reminders for difficult economic times. If you found it useful and think someone else would enjoy a listen, feel free to forward it along. And if you have any feedback, comments, please leave them below or email us at podcast@bayswaterwealth.ca. Thank you so much for listening.
Trademarks owned by Investment Planning Counsel Incorporated and licensed to its subsidiary corporations. Investment Planning Counsel is a fully integrated wealth management company. Mutual funds available through IPC Investment Corporation and IPC Securities Corporation. Securities available through IPC Securities Corporation, a member of the Canadian Investor Protection Fund. Insurance products available through Patrick Briscoe. Independent of his role with IPCIC, Patrick Briscoe is also a co-author in the forthcoming books, entitled Financial Success for Pre-Retirees and Financial Success for Retirees, due out in early 2025.